and create a strategy that fits your personality and gives you your edge in the market. I'm talking about your game plan. I will show you exactly what kind of ingredients you need for great taste, and then we can start cooking. Alright, let's get it. When you create a trading plan, then you have to bring all your knowledge together and select the ingredients that you want to implement in your plan to get the best possible result. If you have written down all the possibilities and rules of a trade, you will never not know what you need to do. Everything has to be written down in your trading plan, and then you have to stick to it religiously to be consistent. Alright, now let me give you an example how you can create a pullback strategy. Let me give this pullback strategy the name the 55% pullback strategy. Alright, so the main goal of the strategy is that we want to catch a good pullback entry in the trend direction after a clear retracement. Then we have to set up some rules. So rules for bullish entry could be, the first rule is we need a 3-leg extension to the upside that confirms a bullish trend. The second rule is we pull our Fibonacci retracement from the previous higher low to the higher high. The third rule is a higher low is only confirmed if the market retraces a minimum of 30% on our Fibonacci retracement tool. Rule number 4 is if the market retraces more than 30% and forms a higher high after that, then you have a new higher low, so you have to adjust your Fibonacci retracement tool. Now we have some rules for bearish entry, which are pretty much the same, just the opposite. So first rule is we need a 3-leg extension to the downside, that confirms a bearish trend. Then the second rule is we pull our Fibonacci retracement from the previous lower high to the lower low. The third rule is a lower high is only confirmed if the market retraces a minimum of 30% on our Fibonacci retracement tool. And rule number 4 is if the market retraces more than 30% and forms a lower low after that, then you have a new higher low, so you have to adjust your fibs. Important, always wait for break of structure before entering again with the pullback strategy. We only trade the first opportunity when price retraces to the 55% level. If we win the trade and the market retraces to 55% again, then we don't take the trade because chances are high that the trend lost its power. Alright, now let's talk about the trade management rules. Trade management rule number 1 could be like we split our maximum risk of, let's say, 2% into 2 positions, for example 1% and 1%, or if we have a risk appetite of 3%, we can take like 1.5% and 1.5%. Use whatever risk appetite fits to your trading plan. And rule number 2, trade management rule number 2 is our entry is around the 55% retracement level. You can either set a pending order that gets triggered as soon as the market hits that area, or you can set yourself an alert and check the price action movement when price reaches the level. It would be great if you see some more confluence around that area, such as previous support or resistance or some kind of structure that will probably cause the market to bounce where you want to get in. And rule number 3 is the stop loss is at the 90% retracement level. So you have to calculate how many pips you have between the 55% and the 90% retracement level, and then you calculate your risk per trade based on the numbers that you have. Let's say you have a 20 pip stop loss and you're trading with a $100,000 account. That means you want to risk like $1,000 per trade, and then you have to divide it by 20, which equals $50 per pip. So $50 per pip is around 5 lot per trade. Then you will enter 2 positions with 5 lot with a 20 pip stop loss. Rule number 4 is the first profit target is the recent high or low, depending on the trend direction, at the 0% fib retracement level. In a bullish market structure, we want to bank our first profit at the recent high, and in a bearish market condition we want to bank profits at the previous low. And rule number 5 is the second profit target for our remaining position is the minus 41% retracement level, which is the Fib extension level of minus 141. It is a major level where price typically likes to retrace, so probably we can use this level to trade in the opposite direction for a quick scalp. I will dive deeper into this topic later on in the counter trend strategy creation example. Then rule number 6 is when the first profit target got hit, we moved the stop loss of the second position in profit at around 30% or 40% Fibonacci level, depending on the structure that we can see around that area. And we don't want to get stopped out too fast, alright? So you have to check the price action on the lower time frame to trail your stop properly. If you like, you can use a trailing stop for the second position as well to secure your profits as the market creates a new structure on the way to your target. You could check the 5 or 50-minute chart to identify the structure on the lower time frame to make a more accurate decision when it comes to placing your stop. You should place your trailing stop manually below the recent valid higher low in uptrend or above the recent lower highs in a downtrend structure. Depending on the market that you are trading, this stop loss can be placed around 10 to 30 pips below the recent valid higher low, okay? So when you think other numbers make more sense for the market that you're trading, then adjust these numbers and set your own rule for that. Write it down and then stick to this rule religiously to make sure you're consistent when it comes to the execution of your trading plan. I want you to always check the history of price to see if you can find some more confluence, such as recent and horizontal levels around the areas where we want to get in and out, or another confluence could be other types of price action signals that you have learned in this course already. Candles with wicks are very important for us. Keep that in mind. It is very crucial to analyze the environment before taking a trade. This is where the magic happens. The way you build your confirmation routine will determine how profitable this strategy can be, and there's only one way to find out what works best, and this is backtesting and journaling each and every trade. What was the reason for the entry? Where you got in? How much risk? How big is your stop? Where is the profit target? Write it down. After the trade is closed, you write down what happened. How big was your drawdown? How big was the move? Did you get stopped out early because of a liquidity grab? Write it down. Write everything down that helps you to clarify what happened, and then analyze how you can improve it. By journaling, backtesting, and analyzing, you will find your edge in the markets, which can benefit you for the rest of your life. The more trades you backtest, the more confidence you are going to have to always stick to your plan, even if you hit a few losses in a row. So if you're disciplined to stick to your plan and stick to your routine, you can have everything you want for your life. Consistency is the mother of mastery. If you want to become a master, then you have to be consistent. This game is all about consistency, risk management and consistency. You have to study everything multiple times to make sure not even one piece of the puzzle is missed. After that, you need to practice what you've learned. Make mistakes, learn from that. Backtest your trading plan, modify it, and get better every day to get on top of your game. You have to practice so hard that you don't have to think about it while you're doing it. You want to be on the level where you open the chart and instantly see the patterns and formation and structures that helps you to identify the environment to make the best trading decision. Alright, now you know how to create a pullback strategy. So now it's time for the other side of the coin. As traders, we make money in both directions. So why not selling an overextended and exhausted uptrend? Let me give you an example of a counter trend strategy and how it can look like. Alright, so the goal is we want to catch the retrace of the overextended move. And then we have to set some rules, okay? So when our second profit target of the 55% pullback strategy at minus 41% got hit, we want to get in the opposite direction to catch the retrace of the overextended move. So our trade management rules are, the first rule is, for example, we trade with 2% risk in one position, or we risk 3% in one position. And the second rule is the entry is at the minus 41 level as a pending order, and if the market triggers our entry, we should have banked profits with our second position of the pullback trade while we are entering the opposite direction at the same time. The third rule is our stop loss is at the minus 80% level. Rule number 4 is we set the pending order after the first target got hit at 0%. Rule number 5 is if the second trade from the pullback gets stopped out, then we delete the pending order immediately. Rule number 6 is our profit target is at the 0% level, so we are trying to ride the retrace from minus 41 to 0%. That means we have a risk reward of 1 to 1. Right. Now let's talk about the third part of kind of a high risk variation that I loved using, especially at the beginning of my career as a trader, to flip my account as quickly as possible. I can only encourage you to make a separate trading account if you want to use this variation of the strategy, because there is a potential that you burn the account. After all, this strategy uses a different money management approach. Depending on the risk-reward ratio that you have, you will scale up your risk after taking a loss. So the principle behind this strategy is very easy. You lose a trade, then you trade a bigger position size on the next potential entry that you find in confluence with your trading plan. And if you lose again, you will stack again on the next potential entry. So some ingredients bring us a bigger piece of the cake if we prepare ourselves for battle and backtest the potential of our combination. The first ingredient is the percentage risk for every trade that we take. If we can make around 1.57 times our risk with a solid win rate of 50% or 60%, then we will be already able to make tons of money. But if we combine it with the strategy that I'm giving you right now, it can be on a way different level. But let me tell you again, even if it works for me, there is no guarantee that it works for you. You have to put the work in and find the right way how to use it, because there are many different ways to trade this strategy, alright? And it is all about finding a combination that works in the environment that we want to trade, that you want to trade, okay? So let me give you an example. Let's say we risk 1% to make a profit of 1.57% in our first position. If we lose this trade, we will lose 1%. So for the next trade, we want to make more than 1% to get rid of the loss from the trade before. So we could put another 1% on the table and would make a gain of 0.57% if we would win the second trade. Or we can risk more than that on the second setup, like 1.5% or 1.7%, to make a bigger gain on the second chance. If we up the risk to 1.7, we would gain 2.67%. minus 1% from the first trade would be 1.67% gain overall. But let's assume this one got lost again, so we have to take back our 2.7% that we lost. Now we scale our risk up to 3% to make a 4.71% gain. So we would be overall in profit with 2.01% if we win the third setup. And if we lose, we could stack again and risk 5% to get rid of all the losses that we took, and so on. Alright, what happens if you start with a risk of 0.5% on the first trade instead of 1%? How would that give you more space for errors? How would that maximize your chances of being undefeatable? What happens if we have a bigger risk-reward ratio, like 2 to 1 or 3 to 1 or 4 to 1 or 5 to 1 or 8 to 1? I would say now it's time to have some fun. Alright, The second ingredient is the risk-reward ratio, the magic potion. With our 55% FIB entry, we would have a 55 to 35 risk-reward ratio at the first target, which equals 1.57 to 1. And we have a 91 to 35 risk-reward ratio at the second target, which equals a 2.6 to 1 ratio. It is not the best ratio, but it would be enough to make consistent gains. If you find a way to get a higher risk-reward ratio with the same accuracy, you will be able to make significantly more. I will go into detail about that in a second. But think about that. How many jabs do you need to punch on your enemy before landing the uppercut one-hit knockout? How long is your breath? You have to sweat more when you prepare yourself for the battle, so you don't have to bleed in the fight. You need to backtest and find your way. I'm here to give you the ideas so you can start experimenting and find your own way. Before you even think about investing, you have to put in the work on backtests and demo accounts. You have to prove to yourself that you can stick to the trading plan. You have to prove that you have consistency in your routines. You need the confidence from the backtest actually to stick to the plan. This is so important. You have to see trading as a serious business. You need to understand how these numbers are correlated so that you can find your best setup. Now let me give you some of the formulas that I use to speed up the process of becoming independent, and after that I will blow your mind with a variation that has much more potential than these formulas. Right now, take a second, write down these formulas so you have it in your notes, okay? Again, this is not an investment advice, okay? Be careful with these numbers. There is a chance that you lose your investment. This is just an example, alright? Maybe your formula only has 5 stacks instead of 8. So if you take the loss after 5 fails in a row, you start with position 1 again. Well, there are many ways to do this, okay? Like I said, you have to find your own way. Find out your possible maximum drawdown in form of how many losses the strategy can bring in a row before you win again. Plan how much you lose in your worst case scenario. How big is the chance that it will happen to you? How much money can be made on the way to the worst case scenario? Can you make 3 or 5 times your investment before taking a bigger hit? How big is the maximum hit that you take? There are many ways you can approach to make this work, but you have to do the backtest and journal. You need to find a formula that fits your trading personality and the environment. Set up a plan, test your limits, modify the plan, master it, and then fight. And now, let me ask you again, what happens if you split your risk into multiple entries with different risk-reward ratios? How would that change everything? Alright, now let us finally implement the last magic potion. The trade management plan, the rich split. And the triple R stands for risk-reward ratio. We split our trade in 3 positions with different risk-reward ratios, with the same stops and the same profit targets. Our first position entry is at the 61.8% Fibonacci level. Our stop loss for all our positions are the 90% Fibonacci retracement level, and the target is always the 0%. The second position entry is at the 72% level, and the third entry is at the 80% level. So the first position would have a risk-reward ratio of 2.18, the second position entry would have a risk reward ratio of 3.93, and the third position entry would have a risk reward ratio of 7.83 to 1. Alright, now let me give you the first variation. Let's say we split our 3% risk in 3 positions of 1% each. In the first scenario, if the first entry got triggered and after that we hit the take profit, we would make 2.18% profit. The second scenario would be that the first position and the second entry would be triggered and hit our take profit after that. So that would make a 2.18% gain plus a 3.93% gain, and that equals 6.11% profit. The third scenario would be the 6.11% plus 7.83%, which equals 13.94% profit in the third scenario, when all 3 entries got triggered and the take profit target got hit after that. Now, our worst case scenario in this case would be a minus 3% loss. Our potential gain for this trade is between 2.18% to 13.94% profit. Alright, now let me give you some more variations that could be great for you as well. Something like 0.5% in the first trade, 1% in the second entry, 1.5 in the third. I mean, you have to check what kind of variation is the best for your trading plan. You have to make the backtest and see which scenario get hit the most. Tweak the levels and play around with it. Alright, now it's time for you to play with these numbers and create a strategy that works in your environment. If my strategy is profitable with only the first entry, how much more money can be made if we smash trade 2 and 3 sometimes, huh? How can you use this risk-reward ratio split in combination with your counter trend strategy? I will not tell you how I would do it, but I'm sure you will find a way. Yeah, think about that and start with your experiments. Now it is game time, alright? Let's get it. Have fun.